and I'm just doing an update on my mathematical stock valuations video, and that's because I added 2 more methods and then updated the spreadsheet just a little here and over here. So I wanted to talk about those. So the first method that the other method that I added is this dividend discount. It's like this dividend discount, but I obtained the required return differently. I use the capital asset pricing model, or CAPM. So the way that works is you still start out with a dividend, annual dividend. You need to know, this part right here is the capital asset pricing model. You need to know the risk-free rate. So typically they use a 10-year treasury note yield. You could substitute that for a 30-year, or it's kind of whatever you consider the so-called guaranteed rate, a risk-free rate. So kind of like one of the most solid investments you can make. Not a lot of risk, so say 2%. And then you want to get some estimate of the market risk premium. So this is saying that if you were to put your money in the stock market, on average you would gain 5%. Now this number can fluctuate wildly, so this one a little bit. Then you input the beta of the stock. That's just something you can get from Google Finance, from Yahoo Finance. And those 3 bits of information calculate this required return. Like so. You take the risk-free rate, and then you add the beta multiplied by the market risk premium. Okay, and then you have a growth rate here. So then the value is just calculated as you would take the whatchamacallit. You would take where did it go? Oh, you take the dividend, you take the current annual dividend, and then you divide it by the required return minus the growth rate. So that's like how it's done over here on the dividend discount, but you simply this required return is calculated instead of just estimated. It's calculated or estimated instead of just assumed outright. Okay. So by that method, the market is undervaluing the stock because the current price is 26.36. Excuse me. Okay, the other way is a little different. It's a free cash flow method. So what you need to do is go to the company's financial statements, and you can obtain their free cash flow. So I believe that's just, you can get that from a cash flow statement, and it's just their cash flow after, it's their net cash flow as far as I understand it, their cash flow with some things subtracted out of it, with expenses and taxes or whatever else subtracted out of it. So for this company, it's about 364 million. You assume a growth rate. You assume just some required return. I just, I'll put that 4%, whatever. Now let's do 6%. Now, so again, it's just an assumption. This calculates a company value. So if you're you're assuming you're getting this cash every year with some growth rate attached to it, and then you do the discounting based on the return and the required return and the growth rate. So like so. So you just estimate a company value, and for this cash, this growth rate assumption, return assumption, about $9.2 billion. Then you need the value of the debt. I have book value of the debt here, but and again, with all this stuff, the specific numbers is not what's important. The methods are what is important, and thinking about valuing. and comparing that calculated value to the market price. So anyways, so you can look in the company's financial statements and find their debt. And so this, I believe, I don't know if this is the book value or what. I think I looked at basically the sum of their debt. So their short-term debt plus their long-term debt. And then I think they had a section where they applied some growth factor to it or something. I forget. I think they called it the fair value of their debt, which was higher than just the sum of their debt. So I wanted to be conservative and take the larger value of their debt. But anyways, so you want some measure of debt. So you also need their outstanding shares. You can get this again from Google Finance or Yahoo Finance. So 177 million shares. And so therefore, if you calculate the company to be valued at $9 billion, and they have about 1.7 in debt, you subtract those two, and that's kind of how much value you're left with. And then if you divide it by the number of shares, that's this value per share, or the share price. Not the market share price, the valuation of the share. So this method values it to be at $42.82 a share, which again the market is undervaluing. Okay, so then what I did, so again, these two methods are ones that I just added. And then I added these methods down here also. I gave them a weight. And then the other column that I added was just, and I added them to the mean valuation and the median valuation to get those in those calculations. And then I added this ranking column just to get a quick look at the summary of the valuations, where 1 ranks at the highest valuation and 11 ranks at the lowest valuation. Okay, so that's all I got. I just wanted to discuss the additional valuation methods that I added to the spreadsheet. So thanks for watching, and I'll see you next video. Bye-bye.